Welcome to this workshop. Trade profitably with the Heikin-Ashi scalping method. Just sit down comfortably and maybe get yourself a coffee or a tea or a small snack, because I'm going to share my concentrated knowledge of 20 years of stock market experience with you in a short time. I respect your time, and that's why I want to start right away. But first of all, thank you for watching this video. The goal of this workshop is to give you the knowledge you need to finally start scalping the stock market in a profitable way. It's no less of a goal than that. This is about profitability, about profits, about finally making profits in the stock market. You will get all 7 modules of my Heikin-Ashi scalping method. And with the knowledge which you will get from these modules, it is actually possible to earn $1,000 a month or even $2,000 a month part-time. So you don't even have to quit your job to use this information. You can do it part-time with a few hours of work a day. You can also do it in the evening. Before we begin, I have to say 2 important things. There are no magic formulas. There is no pill, no miracle cure that will make you money in the stock market. There isn't. I know a lot of people are looking for that, but this workshop is not going to be about that. If you're not willing to put in the time and the work to learn the principles that I want to share with you, then it's not going to work. The second thing I need to address here, it's just the fact that some traders make more money than others. That's just the way it is. And what's also a fact is that some will start making money sooner and some will start making money later. It's just human nature. It's simply related to the prerequisites and experiences. But one thing is for sure, the strategy I'm sharing with you today is the same for everyone, and it always works. So you could say there is equality in that. People are not equal in terms of their preconditions, but the strategy is the same for everyone and it always works. Now, who am I? Most people will know me by my pen name, Heikin-Ashi Trader. I've been a trader since 2001, which is 20 years now. And as you can see, I've been profitable since 2008. In other words, it took me 7 years to become profitable. And I can tell you, 7 years is a very long time. So it took me a lot of effort to learn these principles that I'm sharing with you today for free. It took me 7 years to finally get it. I am the inventor of the Heikin-Ashi scalping method. So here you get the original. I know there are quite a few in the market who are trying to copy me and the Heikin-Ashi methods. I am the author of all trading books that have appeared or been published under the name Heikin-Ashi Trader. I have been financially independent since 2015 and have lived in Cyprus since 2017. I am very satisfied and happy here on this island. Cyprus is the place in Europe that has more than 300 days of sunshine a year. And I have been able to have that thanks to my Heikin-Ashi method. And of course, I'm very happy with that. So I have definitely achieved this goal in life. And if you want to get to know me a little better, you can take a look at my YouTube channel. You only have to type in here Hiking Ashi Trader and you will find me. Here I regularly post videos on trading topics, and there is also a whole series of videos in which I scalp the markets live. Oh, and by the way, the first video is from October 2013, so I'm not just doing this since yesterday. And now we have arrived at the core of the workshop itself, which consists of 7 steps. There are 7 levels with which you can perfectly scalp any market. This first level is called the Hiking Ashi chart. That is, I scalp with and thanks to the Hiking Ashi chart. And if you want to use this method successfully in the market, then you need to get the Hiking Ashi chart somewhere if you don't have it on your platform yet. If you have a broker that doesn't carry the Hiking Ashi chart, then you will have to get it externally. But of course, I recommend brokers that have already implemented this chart into their platform. So just ask. Most brokers already have it. Take a look at this chart type. Candlesticks have been standard in every trading platform for 20 or maybe 30 years, and most traders in the world trade with candlesticks. But we are not going to use this chart here. We will use this, the Hiking Ashi chart. And I'm going back now. This is the exact same chart in the candlestick representation. And now you see it in the Hiking Ashi representation. And now I ask you, which is easier to trade with? This chart or that one? I think the answer is clear. For me, when I discovered the Hiking Ashi candles, it was clear that this was the gateway to success for me. And it is really true that when I started trading with Hiking Ashi candles, I became successful. And you too can scalp perfectly with them. These Hiking Ashi candles work in the hourly chart, in the daily chart, and as you can see, even in the 30-second chart when things are moving very fast. Each candle here on this example represents a trading period of 30 seconds. So what are the advantages of the Hiking Ashi candles? Well, it hardly needs to be said because a picture is worth more than 1,000 words. It visualizes, it shows the trends quite clearly. It's simple. As soon as the color changes, you know what to do. You see here in this example on the right, a downtrend. Then the candles go from black to white, and at that moment you have a long signal. And as soon as we get to the top and the candles change from white to black again, then you close the trade with profit or you go short. It is as simple as that. In other words, the great advantage of using the Hiking Ashi chart is that it shows the trends very clearly and simply. The price trend becomes really obvious, and this results in you getting very clear buy and sell signals. And what more do you want as a trader? Exactly that. In other words, uncertainties are filtered out and you get a clear indication of what to do. And as I said, it works at any time level. If you're more of a swing trader, you can use it just as well as we do as scalpers. Now we come to the most important part of the whole workshop. On what principle do I trade? I call it the basic setup, and you will see what it's all about. If you look at this chart that I'm showing here, you can see this beautiful upward movement here on the right side of the chart. And I ask you, could you predict this movement based on what has gone here before? It is the basic principle of my trading and my scalping that you cannot predict a movement such as the one indicated by the red arrow on the right here, although technical analysis tries to do it anyway. You can't predict such a move, in my belief. And if you do predict it by chance, it's more of a coincidence. So the basic principle of my trading philosophy is that you just can't predict this move, although technical analysis keeps trying. It's a pity, because of course, I would like to buy down here on the right and sell at the top. Of course, I would like to do that if I knew in advance, but I just don't know. Second question. After this move went up, as in the previous example, then this one followed on the right where the red arrow is. And my question is again, could you predict this movement? Well, predict maybe not, but I can expect it. Because it is a basic principle in the stock market that prices always return to their mean. That is, if a market has moved far away from its mean, then you can usually expect a counter movement, which is also called a technical counter movement. You can scalp on this, in my view. So yes, we can make a statement about the expected counter movement. What I cannot say is how big this technical counter movement will be, or how long it will last, how much of the previous move will be corrected. I can't say that, but what I can say is that I can expect a correction. We should elaborate on this now. I want to take a closer look at the Heikin Ashi scalping setup, which is of course based on the assumption that we mostly get a counter move after a significant initial move. The black candles indicate a falling tendency, a bear market, so to say. And at some point, the candles get smaller. You can see that here at the bottom. That is, the market starts to consolidate, and then at some point, the first white candle appears. So, as soon as the color changes, the underlying trend changes. And at that moment, I can buy. So I can open a long position, a buying position. And I stay in the market, I stay in this trend as long as the Heikin Ashi candles are white. Only after this movement, when the first black candle appears, here, should I close the position with profit. It is as simple as that. So let us look at long signals or buy signals. And here we have a flawless long signal. So go long as soon as the color of the candles changes from black to white. Well, I choose to work here with black and white, but you can also do it with red and green, depending on which colors you like to choose for falling and rising markets. So you go long when the color of the candles changes from black to white, and you close the position when the color of the candles changes back to black. And of course, for short signals, for selling signals, it's the other way around. Here we have first a rising market, so only white candles, and you go short, you'll sell as soon as the color of the candles changes from white to black. And you close the position as soon as the color changes again, in this case back to white, where the green arrow is. So you go short at the red arrow, and as soon as the white candle appears, you close the position. Some traders close, for example, the half of position, and for example, the last half position at the next white candle. But these are simply subtleties. The principles should be clear. You get very clear buy and sell signals. Step 4. Reversal formations. This is also an important principle, and just like with the candlesticks, we have so-called reversal patterns or reversal formations in the Heikin Ashi chart. They are easy to understand. We also know this from the candlestick language, a doji. Maybe you know the Japanese invented that kind of funny interpretation of price movements. But I think they are quite useful to better understand what is going on in the market. So, a doji is characterized by a shorter length of the shadows, which are those vertical lines under and above the horizontal line. A doji depicts a small trading range, and because of that, you see that there is little or no candlestick body, because the opening price and the closing price are practically the same. Therefore, it looks like a little cross. This is the principle of a doji. What does that mean? It means that there is a balance between buyers and sellers. The market consolidates and seeks a new equilibrium. A variation of the doji is a spinning top. You see, the shadows under and above the candle body are much longer. However, we also mostly have a small candle body. That is basically the same as in the doji, except that the volatility in this time frame is higher than in the doji. In the doji, there is a little movement. Here, when you have a spinning top, there's much more movement. That is, the bulls fight with the bears for supremacy on the market. And the next candles will then decide which of the two will win. Let's look at an example. In this case, we have a rising trend, and you see after the uptrend made a final high, there was a smaller white candle, and then a spinning top appeared. And after that, where the blue arrow is, you see a doji, a little cross. That's the sign of a doji, and that was a clear signal that the trend was changing, that the bears are now taking over here, and that the market is starting to fall again. You could see the doji as a signal that the trader can go short or sell on the next black candle. So in this case, it indicated a clear reversal of the price action. The next step has to do with volatility and, of course, with the stop, because we have to talk about that as well. It is important to know where you should put the stop and how far your stop should be from the entry point. Above all, it is important to know what you should do with the stop once you are in the trade. I can illustrate this with an example. I will show you a trade that I made in the currency pair US dollar Japanese yen. I was able to execute this trade with a stop of 1 pip. As a scalper, there's actually in certain currency pairs the possibility to do this. Take a look at this example here in the 1 minute chart. You can see that the market is going down, you can see by the shadows under the candles at the bottom that the market could possibly turn. I went long a little bit early here, I'll admit, because I had the feeling that this was going to happen, and I put a stop, a pip, below that entry point. So the entry was at 105,785, and the stop was at 105,775. Thus, only 1 pip distance from the present price action. So the green line was my entry, and the red line was my stop. Not coincidentally, the entry was about the same level at which the market had turned earlier. That's another principle that we'll take a look at in another stage. When that comes together, when the market approaches a formal swing low and it turns again at that point, then of course you have a second confirmation for your trade. That's interesting because that gives you a second reason to open a long position here. And then the reason to go long is much stronger than if you decide to buy just basing on the Heiken Ashi candles. That's what happened next. In fact, there was another candle that tested the low, but the market did not hit my stop. And after 1 minute, I was already up a pip and a half. The stop was still at 105,775, so still where I originally put it. But you see, in that case, we are already up a little bit, and that's a great feeling, of course. By the way, it means that if you scalp with very tight stops, you're taking a very small risk. This also means that you may be scalping with much larger positions than you normally could. And of course, we need to talk about that as well. So you see, after 1 minute, I was already up almost 3 pips. When that's the case, I start pulling the stop closer to my entry. You see, it's only half a pip away from my entry, down there where I drew the red arrow. You see, I moved the line up a little bit to limit the risk. After 2 minutes, the market continued to move up, and I was able to place the stop even above my entry. In this case, I was already 1.5 pips in the plus, secured. This is then called a free trade. That is, the trade can no longer lose. The worst that can happen is that the market comes back and takes the stop out of the market. But then you would still have made a pip and a half profit. After 3 minutes, the market continued to rise, and I was able to pull the stop up a bit more. So everything was going well. And as you see, after a few more minutes, you see that the market has almost reached the previous high. And when I see that, that is the point at which I expect some kind of consolidation. So I expect that dojis or spinning tops will appear, or that the color of the Heiken Ashi candle will change, and we will see black candles instead of white candles. And as you see, that is exactly what happened. And that's of course the moment where you should close your trade at the latest. So I had a nice 7 pips profit in 7 minutes time. And if you do that with a big position, like for instance 5 standard lots, that's $500,000, that depends on the size of your account of course, you can have a couple $100 profit quickly. This is a good example here of why you should adjust the stop on volatility. Here, the volatility was very small because usually the US dollar Japanese yen currency pair doesn't move much. That is why you can work with very tight stops. But in return, of course, the price targets, the possible profit is also smaller. A completely different example is this trade here, which I made in the Dow Jones future. The Dow Jones is, of course, a very different thing than, for example, the US dollar, Japanese yen. And it's clear that you have to work with a very different stop distance here. You can see a clear downward movement on the left side of the chart. And just after 12 o'clock, we see the Dow hit a support line that I had identified earlier, almost exactly on the dot. And that wasn't the round number 36,000 points by chance either. Based on those two facts, the support and the round number, I became interested and started watching the chart closely. My guess was that the market could possibly turn at that point. I got the confirmation of that by the hiking Ashi candles, which turned green after being red all the time before. Where the green arrow is at the bottom, I went long based on this green candle, and the entry was at 36,003. The low of the previous move was at 35,997. So that means that we are entering here 6 points away from the lowest point. And that means that I could set my stop loss quite a bit tighter than usual in the Dow Jones. I chose initial stop distance of 15 points. So I put the stop at 35,988 points. If the market would take my stop out, that would mean for me that the downward trend from before was not over. Therefore, I set the stop exactly there. So you can see the clear difference from the US dollar Japanese yen trade. In this case, I have to work with a stop of 15 points, and this is, of course, because of the much larger fluctuation range in the Dow Jones compared to the US dollar Japanese yen. Nevertheless, it is important to emphasize that the stop distance is never the same. I know some traders are trying to do this. They say, well, I used to trade with a stop of 10 points and I tried to get 20 points. That might seem to solve the stop problem, but that's not how markets work. You should determine your stops according to the current market situation and also according to the market in which you are trading. For example, if you're trading the euro US dollar, you can often scalp very well with a stop of 3 to 5 pips. On the other hand, in the US dollar Japanese yen, it often works very well with 1 or 2 pips. In the Dow Jones, I usually need 20 to 25 points when I scalp. But here, in this example, I was lucky to scalp with a stop of just 15 points. And as you can see, the trade in the Dow Jones worked very well, and I was able to exit with a profit of 50 points. You see the exit where I drew the red arrow. I would like to summarize this chapter on stops and volatility for some typical trading markets. So let's say euro US dollar, you usually need 3 or 4 pip stop distance. For the US dollar Japanese yen, I said 1 to 2 pip. And for example, for the E-mini future, I would use 1 to 2 points stop. For the Dow Jones future, 15 to 25 points stop. And if you trade Bitcoin, you probably will need $100 to $200 stop distance. The sixth step is directly related to step 5, adjusting position size to risk management. Obviously, we first need to know how much trading capital we have available, and then, if I know where my stop will be, I can determine how big my position will be for each trade. When I scalp, I risk only 0.2 to 0.3% of my capital per trade. I am fully aware that for some traders, this might be a bit of a surprise. I know in the trader community, you often get recommended the 1% rule. Many traders are scalping or trading using this 1% rule. I personally don't, and here is why. Bad days can happen when you're trading. I don't know if you have had bad days before, but I had bad days in which I had 7, 8, 10, even 11 losing trades in a row. If you risk 1% per trade, you may lose 10, 11, or even 12% of your capital. That means that you then have to make 13, 14, or even 15% profit just to break even. It's doable, but it's not easy. Plus, there is the psychological pressure. But if you trade or scalp with small risks, as I do, and as I recommend, you can execute your trades in a totally relaxed way. And if you have a losing trade, it doesn't affect you. You just know that the next trade might be a winning trade again. So I'm fine with 0.2 to 0.3%. I realize that's going to be difficult for some traders. They may say, yes, my dear hike-in ASCII trader, that's all well and good if you have a lot of money, but I only have $2,000 to my name. How am I supposed to do that? Let's just assume you have $5,000 trading capital. That's quite an average for many traders. I know there are traders who have to start with less, but there are also traders who have more. So those $5,000 example is just a kind of average. And let's just take a close look at this 0.3% rule. Let's say a scalper specializes in forex trading and he trades the euro US dollar. As we said earlier, this can be done with a stop of 5 pips, at least if we consider the current market situation. So if he trades 3 mini lots, with 1 mini lot representing $10,000, that would be $30,000 in total. In that case, if he chooses a stop distance of 5 pips, he would be risking $15 per trade. That would be a little less than 0.3% of his trading capital. Now you might say that's just a small risk, but that's how you should scalp with completely peace of mind, giving a trading capital of $5,000. You can calmly build up your account with this kind of risk management. Let's look at an example in the micro E-mini Dow Jones future. This is a future that was introduced specifically for small investors. And if you have limited capital, and $5,000 is limited capital, I would recommend that you trade these micro futures first before moving to the E-mini or mini Dow future. So let's say the scalper trades the Dow Jones micro future and he uses a stop of 15 points. He would then risk $15 per contract, and that would be exactly those 0.3% of his trading capital, assuming he has $5,000 to his name. So, in that case, he can only trade 1 contract. That is how I would do it if I started with a capital of $5,000. With anything below $25,000, I would not trade the usual futures like the E-mini or the mini Dow future. From $25,000 on, you can trade those futures. That would work, but with $5,000, I would rather concentrate on the micro futures, and with that you will do fine using risk management of 0.3%. To illustrate this in more detail, let's just look at the two examples I mentioned earlier. So first of all, this trade here in the US dollar Japanese yen. You remember this was a trade, a short scalp in the 1 minute chart with a stop of 1 pip. Now, how did this trade work exactly? If we work with a stop distance of 1 pip and we want to take a risk of only 0.3% and we have an account of $5,000, then we can risk a maximum of $15. But by having a stop distance of only 1 pip distance, we can take a much larger position than usual. We can take a position size of $150,000 in this case. So in that case, the risk was $15 and we had 7 pips profit. That would have yielded $105 within just under 7 or 8 minutes. I think that's not bad. You see, there are possibilities, despite a relatively small capital, to make good profits and to scalp with very small risks. For example, if you focus on forex trading and you specialize on those kinds of forex pairs where you can work with small stop distances, you can certainly scalp with larger position sizes, as here in this example. Now, let's look at the trade in the Dow Jones. If you remember, it needs a much larger stop distance here. That was 15 points. So the initial risk in this case was also $15. The entry was at 36,000 and the stop was at 35,985. The exit was at 36,050. So here, after 20 minutes, the trader had 50 points or $50 profit if he had traded with 1 micro contract on the Dow Jones. That's not bad either. But you can clearly see that if you compare the Dow trade with the trade in the US dollar Japanese yen, that the conditions in the Dow Jones are not that good as in the US dollar Japanese yen trade. The trader had a larger gain in the currency pair because he was able to work with a tighter stop and therefore with a larger position. And thus, he could adapt the position better to market conditions and have an optimal use of his capital. Whereas for the Dow trade, he could only trade 1 contract because of the bigger stop distance. I hope you can see this difference. However, as soon as you have a larger amount of capital, things become completely different. You have many more possibilities to trade and choose the optimal position size for your trades. That is the advantage of having more capital to trade. So, from that point of view, it is important to ask yourself the question, what are my possibilities if I have this or that trading capital available, and what are actually the best markets for scalping? And in this case, when you only have $5,000 to your name, you have to say it very clearly, I would specialize in forex trading and not trading indices like the Dow Jones or the E-mini. Step 7. Scalp like a sniper. What do I mean by that? Scalp only high quality signals. I cannot stress that enough. Many traders scalp way too much and they trade on too many insignificant signals. And how do we find the best signal? Focus on finding interesting turning points in the chart on the higher time frames, and by that I mean at least the 15-minute chart and often also in the hourly chart, so that you have more information over several days, or if necessary, even several weeks. Then I look at the shorter time frames and try to scalp those turning points on those time frames. That is the whole secret, so to speak. Let's take a look at this example here in the 15-minute chart of the Dow Jones. I've drawn various lines here, which of course corresponded to certain support and resistance levels. For me, the interesting trades are where the market touches one of those lines. So, for instance, here and here, as you can see. Everything that happens between those lines does not interest me. I scalp the extreme points where the market touches a significant level, because I know from experience that there is a high probability that the market will turn when it touches these levels, at least for a certain time. And I try as a scalper to profit from that. For example, I want to draw your attention to this high here from November the 3rd. You see here where I drew the blue arrow here on the left. That level was at 36,200 points in the Dow Jones. After the market was able to overcome this level, a few days later, you see it here, it came back and tested this level again here, where I drew the green arrow. In technical analysis, we talk about resistance becoming support. And exactly these kinds of tests are interesting because I know that I can often make a good profit here if I scalp this. So I went long here at the green arrow as the market tested this support level. As I said, I scalped the extremes, the pivotal points at support and resistance. Those trades are usually of better quality and also yield more profit. And now let's look at this trade in the 1-minute chart. So I said I went long here at the green arrow at 36,215 and I just got out 5 minutes later at 36,260 here at the blue arrow. That's 45 points after all, after 5 minutes. So that's the idea. Spot interesting pivotal points on the higher time frames and scalp them on the lower time frames. Remember, after sharing the 7 steps with you, I just want to summarize the whole strategy again. So we are going to scalp with the Heiken Ashi chart. If you don't have it, go get it. It's really worth it. We are trading a technical reaction to a previous or initial move. So we do not trade the move itself, but the reaction to this move. That's quite important because that confuses many, and some traders continue to trade in a classical way as technical analysis dictates. I don't. I trade or scalp a technical reaction on a larger movement. We get in when the color of the Heiken Ashi candles changes, and we also get out when the color changes again. We watch for reversal formation, if possible, such as dojis and or spinning tops, which may show up simultaneously, one after the other, or they may not. We try to align our stops with the volatility of the market. That means it's different if you are trading the euro US dollar or the Dow Jones or crude oil, for example, or if you are trading a low volatile currency pair like, for instance, the euro British pound. For each market, you need a completely different stop distance. If we have this number, then we can calculate the position size with which we want to trade. In other words, the position size will be based on risk management. Last but not least, we try to adopt a sniper mentality. That is, we only go into the market when everything is right, when all the elements come together. In other words, when the situation is optimal. Let's say you have this $5,000 in trading capital and you set yourself a goal of making $1,000 profit in a month. That's ambitious, but it is possible. When I say $1,000, of course, I mean $1,000 on average. Sometimes you may make $1,500. On other months, you may only make $400 or $600. It doesn't matter, but we're trying to make a gain of $1,000 on average with $5,000 in capital. Is that possible? Is it possible if we assume about 20 trading days a month? Then we know that we need to make on average $50 a day with scalp trades. We only pick the quality trades, so you will enter a maximum of 3 to 5 scalp trades a day. If we assume 3 scalp trades, is it possible for you to make an average profit of $17 per trade with this scalping strategy? Do you think that is possible? After everything I've shown you today, do you think you can achieve this with this strategy? Well, I think it's definitely possible. I think with a little practice, it should be possible to make that $17 average profit. Now, you have 2 options. After this workshop, and after I shared the 7 steps of my strategy with you, you can figure out again on your own where and when to scalp. You can try to figure out on your own where to find these sniper trades in the market. So you can try to finally become profitable without any help. That's one possibility. The second option is to learn scalping from someone who has been doing it for 20 years and who has become financially independent thanks to this method, and who wants to share all his experience and knowledge with you. And this knowledge is available to you right now and at any time. And here it is. There is an online scalping course with the Heiken-Ashi chart, a method with which you can make money on the stock market every day. This course is called Scalping is Fun, after the book I wrote with the same name. With this course, you will take your trading business into your own hands and will learn in a systematic way how to handle the right leverage. You decide yourself when and how much you want to scalp. You don't have to sit in front of the computer screen all day and scalp for 12 hours. That is not necessary at all. There are many scalpers who do it with 2 hours. But scalping can be your gateway to freedom and financial independence. And the course shows you the exact steps to achieve this goal. So what is the content of this online course? There are 8 modules. Module 1 why scalping is different from all other trading methods. What makes scalping different of all other trading strategies and why it is unique. In this module, I also show you why scalping needs to be trained for, like a sport. You are not as good at the beginning as you will be after, say, 6 months or a year. You have to train for it, but you can become a specialist in something thanks to scalping. And that is the key to success. All successful traders are specialists in a certain area in the stock market. And the more you do it, the better you become and the more money you make. In the second module, we want to deepen the Heikin-Ashi setup that I presented in the workshop here. There are little details that will help you. Sometimes the difference between success and unsuccess is really a detail. That is why the basic setup is such a powerful pattern and one that can be successfully traded over and over again. It always works. Whether you start scalping now or 5 years from now, it doesn't matter. This pattern will always be there. I will also show you in this module what the technical and scientific fundamentals of the setup are, and especially why the Heikin-Ashi chart is the best tool to profit from this principle. You will also get concrete examples of how to scalp the market and what signals from the market I pay attention to. And this is also very important, on which days you should avoid certain markets. In the third module, we will go deeper into the entry strategies. I have shown the entry strategy in the basic setup, but there are variations. I'll show you why you can scalp better with limit orders and dramatically improve your risk-reward ratio. We will talk about certain entry setups, the round number in the market, the so-called fakes, the fake moves of the big players, as I call them, and the test the waters entries. And we will of course talk about market setups that you should avoid and the ones that you can scalp well. With that knowledge, you're going to greatly optimize and improve your entries. We'll also talk about stop management. Stops are important, and I will talk about the important insight of why losing trades are not the problem, and why they are even necessary to participate in the trading game at all. I will talk about why the stop order is the central tool of risk management and therefore directly related to making money. I also show you in this module how, as a scalper, you should incorporate a timing component into your stop management, and how you can scalp in the forex market with very tight stops and thereby drastically improve your chances of lasting profitability. In Module 5, I go into exit strategies. How to determine exits with the Heikin-Ashi chart. How you can maximize your profits with trading stops and stay in the trade despite short-term setbacks, which very often occur. And above all, how you can get the most out of your trade thanks to swing highs and swing lows. In Module 6, I'll talk about position sizing. We've already touched on that, how to calculate the exact position size for each trade and thus manage your capital optimally. How you can scalp with large positions thanks to tight stops and still remain completely relaxed because you're scalping in line with your risk management and in a reasonable ratio to your trading capital. In Module 7, I'm going to share a whole series of videos with you. It's over a month of videos, so over 20 videos of each day in a row, in which I analyze the German DAX, the Dow Jones, the Euro, US dollar, and Bitcoin, and show exact pivot points in the market. And I do it in advance, not afterwards. In other words, with these daily analysis, you will learn to determine the exact swing levels where the market often turns. It's a training program to sharpen your eye and improve your observation skills, to find the exact points in the chart where the market may turn. With these videos, you can follow day by day which levels become important before the trading day even starts. Last but not least, in the 8th module, there are a number of videos of live trades that I have made. So video recordings in which you can follow which markets I scalp and why, where I enter and where I exit, and of course, how I manage to stop. And all of that is of course commented on by me. So, what will you get when you buy this course? You will get over 50 videos of learning material, and I can assure you the learning material will be updated regularly. That's over 6 hours of training to take your scalping business to the highest level. With me, you get a coach at your side who has 20 years of trading experience and who will be happy to answer all your questions about scalping and trading in general. And it is the original. This is the Heikin Ashi scalping strategy from the inventor of the method. You get 20 years of trading experience compacted into one course. You get live trading sessions, and you get the bonus book, Scalping is Fun. And you always have email contact with me once you buy the course. You can start today for only $498. All you have to do is click on the button below to sign up. That said, there is a 100% security for you when you sign up and a 60 days money-back guarantee. You can watch all the videos. You can start trading based on this learning material, and if for any reason you're not satisfied with your purchase after 60 days, just send me an email and I will refund your money immediately with no questions asked from my side. In other words, you have no risk whatsoever with this course. I take the risk away from you. Now, it might be interesting for you to hear what traders say who have been scalping with my method for a long time. One trader said, "I was so tired of hearing that scalping is not the way to trade." Excuse me? Scalping is not the way to trade? Is it day trading? Is it swing trading? Or what should it be? Why wouldn't scalping be a proper method? Have you ever heard of Paul Rotter? Paul Rotter, the king of the Eurex? He is a scalper. Paul Rotter trades in so-called interest rate futures, which are futures on the interest rate markets. For example, the German Bund future. Rotter only goes for a few ticks, so he's not a swing trader or someone who is in the market for a long time. If he has a profit of 2 or 3 ticks, he takes it. And a couple of ticks for Paul Rotter is quickly the value of a single family home. Do you know this guy trades a volume of about 50 billion a day? A day! So to say that scalping is not the way to trade, surely that's an outright lie. Another trader wrote, "After I learned about the Heikin Ashi trader's method, I had a breakthrough." I've heard this many times in the past years, and some traders have also called me or written me to thank me for the method, and of course, that made me very happy. Or, what I also hear often, "For the first time I have consistently started making profits." Of course, that also makes me happy. I hope that one day you too will be able to say, "For the first time I started making profits consistently." Another trader said, "Once you master the strategy, it's a hell of a lot of fun scalping the DAX or the Dow Jones." I've heard this from traders more than once as well. Now, there may still be questions that you have if you're thinking about taking this course. Maybe you're wondering how much time it actually takes to become a profitable trader. There are traders who are immediately profitable with this course, but of course, sometimes there are traders who have some experience, who have traded before, or who have been trading for maybe a few months or even years. That shouldn't stop you from buying the course. There may be traders who wrestle with certain mental blocks. Maybe you are one of those traders, and I think this course can help you overcome those blocks. And it might be related, for example, simply to that first comment from earlier, whether you're actually allowed to scalp. Is it allowed? Should I do that? And if this course can help you with one thing, I think it's with that question. Yes, you're allowed to scalp. Yes, it is a legitimate way to be active in the stock market. Why not? Another question I get regularly: how much capital do I actually need to make a living with scalping? I only have $2,000 to my name. I only have $6,000 or whatever. I've given the $5,000 example in this workshop here, and it's clear that someone who brings, I say, $100,000 is in a slightly more comfortable situation than someone who only has $10,000. But one thing is certain: if you can't do it with $5,000, you can't do it with $50,000, and you certainly can't do it with $500,000. It's about first acquiring the skill to be able to scalp profitably. And that's what this course is about. Here you are invited to learn this skill. And if you put in the effort, and if you practice and train, one day you will become profitable. Then there are traders who say, "I just don't understand how to do it. I just don't get it." And this course is also made for those traders. Scalping is fun, shows you ways, and gives you all the important components to realize your success. It takes a certain knowledge, and I share this knowledge with you. It's not secret knowledge. It's sometimes about little tricks, little details that make the difference, and you'll get them in this course. So go for it. Then there are traders who say, "The stock market is so chaotic and difficult. Is it really possible for me to become profitable?" Look, I have a simple answer to that as well. Every year, tens of thousands, if not hundreds of thousands of new traders enter the market. Think about that. If you look from a perspective of today, at the traders that are entering the market a year from now, they will not have the knowledge that you can acquire today. You will have a year's head start. You can get that knowledge today with this course. What's holding you back? That's what I want to share with you today. And I just want to say thank you for listening to this workshop, for taking the time to hear what I have to say. So thank you very much. Just do something with this idea of becoming a profitable trader. You can easily sign up by clicking on the button below. Just do it. Check it out. You will see you will not regret it. Thank you and all the best to you. And I'll see you on the inside of the course. I'll be by your side. I'm here to help you.